Welcome to the Melbourne Property Podcast, hosted by Sky and Lindsay Hammer from Convergence Buyers Agents, your local property experts.
This podcast is your go-to source for insights, trends and tips on navigating the ever-changing Melbourne property market.
Whether you're buying an investment property or your dream home, stay tuned for the next 30 minutes as we give you exclusive insights that will shape your next property purchase. Let's dive in.
Hi, my name's Sky and welcome to another episode of the Melbourne Property Podcast. Now, today's podcast is an interesting one. It's called The Beginner's Guide to Investing in Melbourne, but to be honest, we're going to work through a process you can use anywhere. So it's not just talking about the Melbourne property market, we're actually talking about how we go about identifying suburbs that we think are going to outperform over the next 12 months to kind of 10 plus years. So for us, we're going to break down the macro, we're going to break down the micro, and we're going to work through what that process looks like. Thankfully, both Lindsay and myself are actually going to talk about our next property purchase. So we're going to break down that a little bit today, but there is another episode dedicated to this. But today, it's more working through where we're looking to invest. We're not going to give out the exact suburbs right in this episode, but we're going to talk about the process. So again, if you're listening to this property podcast in Sydney or Brisbane, and you may be looking to actually buy in one of those locations, this process is actually going to help you. So really exciting episode. I debated about whether sharing all this insight, to be honest, because obviously this is what our clients pay us to do for them. But I think there's a lot of good takeaways for our listeners from this episode. So that's enough about the episode. Lindsay, how are you today?
I'm really good, thanks, Guy. I'm excited about this episode because I think it's just a really good foundation for so many investors or people who are looking to invest, whether you've done it before, there may be things that you've missed or you've overlooked, and just, a really good overview of where to start, which is what many people want.
Exactly. And we've timed this one for that kind of, depending on release date, end of December, early January. Hopefully you've got some time off. A lot of people kick down, relax over this time of the year, but it's also a good time to set yourself up for a successful 2026 as well. So if you've been talking about buying property, like I know people we speak to that have been talking to us on and off for a year and haven't bought a property, maybe this is the kind of episode you need to kind of sit down, focus, and then get ready to maybe buy that property in 2026.
Absolutely. And as always, we do our icebreaker though. So, Sky, what are you loving about Melbourne right now?
Just the summer vibes. It's just it's finally starting to warm up. It's been a really kind of long spring, non-existent spring, to be honest. Everyone's happy. Everyone's kind of, I think, a few tired people getting around, but to be honest, I think everyone's looking forward to kind of seeing through the end of the year and then obviously having that kind of, break and time away with family. For us, we're getting out of Melbourne, we're heading over to the US, spending a bit of time with friends over there and then sneaking back through Tokyo and spending some time with the family. So obviously really looking forward to that as well.
Very good.
And what about yourself?
I'm actually just looking forward to kicking off 2026 with a bang. So this time of year, whilst I'm sort of winding down and getting a little bit over the year that has been, I'm also kind of in that headspace where I'm planning for 2026. So I think that's why this is a great episode to really kick things off with.
Let's jump into it. So as I said, what we're going to do is talk about kind of the process we go through. And so we're obviously doing it for ourselves again right now, but this is what we go through with our clients all the time. So we'll break it up into a few segments. But the first question we always ask and lead with is what's your strategy? And I'd say 99% of people don't have a strategy. And that's the main concern because they're saying, I'm going out, I want to buy a property for $850K in Melbourne. I was like, but why? And so that's the kind of, we're going to unpack at the start because you really need to do that first because depending on what your strategy is, it's really going to kind of impact on what property you buy, what structure you buy it in, whether you in terms of questions for your brokers, your accountants, everyone like that, you need to have that strategy in place. And so if you don't, you're kind of just investing for the sake of investing. You could probably still do well out of that, particularly if you're buying in the Melbourne market next year. But again, it's not what you want to be doing. So for us, the strategy is the first one. And so we'll use us as an example. For us, it's a self-managed super fund purchase. We're looking to make a purchase up to around that maybe 1.2 mark. So we're just looking for a kind of foundational asset. We're going to sit in there. It's going to do its thing over the next 10, 20 years. There are a few different schools of thought for super, myself included. I'm not opposed to selling that in say 5 or 10 years. If it doubles, we might sell that, take advantage of that 15% taxation in super and then roll that into a bigger, better asset potentially. But right now, what we're thinking is 10-year time frame. It's called potentially up to 20 years. So we're just looking for a really good asset. So that's kind of what we're doing in a growth location where it's going to outperform the rest of Melbourne, but also other opportunities across the country. So that's, overall, what we're trying to do. But then for us, in this instance, which differs to maybe a lot of clients who may be buying in personal name or trust, we're not desperate for equity extraction. So we're not saying we need a property that in 12 months' time we're going to pull out $200K in equity, which we can do, and that is often what we're trying to do for clients. But we're not trying to do that in super. So that's not what we're looking to do. So for us, we don't have to be buying in the hottest markets right now, which we do for say Frankston, Carrum Downs, Frankston North, we don't necessarily have to buy there and get that kind of instant equity when we're buying kind of below market value, off market, all that type of stuff. For us, our time horizon is a lot further. So that's the kind of, I guess, in a nutshell, that kind of strategy, what we're looking to do. And again, everyone's brief is different, but for us, that's kind of what we're doing with this process right now.
I think for first-time investors, if you've never done this before, one way that you can sort of tease out what your goals are is by looking at the end of the whole process. So when do you want to retire? Do you have a particular age that you're looking to retire? It might be 50, might be 60, could be 65, whenever that is. And do you have a passive income goal? So by that, we mean how much income do you want to be receiving? And that's passive. So it's coming from the rent, coming from the properties and those sorts of things. So I think that's always a really good start point, because then you can work backwards from that to figure out, maybe you've already got a few properties. How close are you to reaching that goal?
Yeah, exactly. Yeah. So you've got to have that conversation up front. For us, again, we've already spoken with brokers, accountants, financial planners, so we've kind of done all that heavy lifting. But if you haven't done that already, now would also be the time where you'd be speaking to your broker. So saying, these are my circumstances, how much can I borrow? And if it's, I guess, up to 900K, great, you know what your borrowing capacity is. Do you have the equity or cash to actually afford a deposit to buy that property? And then obviously, what is the intention with this property? Are you looking to sell it 2 or 3 years, 10 years, all that kind of stuff? Are you planning to do a development or granny flat potential? That's where you got to have all these conversations now, not as kind of nice to haves or kind of thinking about 2-3 years after you've purchased the property.
But even things like a potential career change or parental leave, those sorts of things that might be on the horizon, if you are going to have to upgrade your principal place of residence, you can factor all those things into the strategy at certain times throughout your property investing journey.
Exactly. Yep. Okay, so that's enough on strategy. We're not going to do a full strategy session for ourselves on that. So once we've kind of nailed that strategy, we know what we're actually trying to do. That's when we move more into kind of suburb selection. So for us, it's finding suburbs that are actually going to align with those goals. So whether that's granny flat potential, in our case, kind of SMSF, we've got to kind of make sure they kind of marry up. So there's a process we go through, and there's lots of platforms we use from a data perspective to do that. But I guess at a bigger kind of macro level as well, we're looking at things like infrastructure spending. We're looking at, I guess, the long-term performance of this market. Is it a market where it's quite volatile, where it's going to grow 20, 30% a year and then go backwards over an extended period? Or is it more, I guess, traditionally for Melbourne in particular, is it a 5, 6, 7% a year type of market, which again, doesn't do that every year, but you're not getting those wild swings. You're getting, I guess, a more consistent growth, limited downside risk, but again, not that explosive growth like we see in some other cities, particularly places like Brisbane, one of those markets where it does a lot and then it does absolutely nothing for an extended period, and very boom or bust, Perth being another one that has a similar kind of trajectory.
I think another thing when we're talking about at that macro level, you touched on infrastructure, but also just the economy and whether it's a diverse economy or if it's reliant on one particular industry. Some of those examples you just spoke about, for example, they're reliant on the mining industry. So you're going to see that at a macro level when we're doing this suburb selection.
Yep. Yeah. And for us, like that's the Melbourne Property Podcast. We're focusing in on Melbourne for this. But again, like you've got infrastructure, transport, schooling. Melbourne ticks so many of those boxes. Melbourne economy, on the other hand, is, I would say, in a more of like kind of revitalisation stage. Like the overhanging kind of question is about the debt. Like the debt is obviously out of control. But if you look at what's happening, I guess at a lower level, so like Melbourne and Victoria as a whole is starting to attract more people back. So in terms of the number of people leaving versus the number of people that are going out, there's more people returning, I guess.
From a migration perspective,
from a migration,
or property investors?
In migration.
Or both.
Yeah, or both. Yeah, exactly right. So we have seen that turnaround. So again, it used to be everyone, like a mass exodus out of Victoria, going to Queensland, just about any other place in Australia or the world, where that's turned around again. Some of that is obviously international migration, but interestingly, some of that is internal migration again. So people that maybe had their 2 or 3 years up in the sun in Queensland, but are returning back to Victoria due to work or due to family commitments, that type of thing. So that's obviously a positive sign to see as well.
On the macro level, one of the other things that we really consider, and a lot of our listeners would know this, is owner-occupiers. So many listeners would know that growth is often driven by owner-occupiers in an area. So we're looking at suburbs where it's predominantly owner-occupiers. They're going to, drive up that capital growth in the suburb. They're overpaying. You'll see it at auctions in particular. There's not a lot of stock on the market, so there's a lot of scarcity and that high demand is there.
Yeah, and a great example, I had a call with someone today. She downloaded one of our reports recently, and I just kind of rang her up just to have a chat because she'd been looking to buy for a while. She bought at auction on the weekend. So I said, oh, great, like where'd you buy, what'd you pay? And so she bought in the northern suburbs of Melbourne, $240,000 above the price guide. So I think it was around $950 she paid. And she's like, I was just keen to get into the market. I was like, yeah. She's like, I've been looking for a while. This whole 5% deposit scheme thing happened, and so she's jumped in and probably paid way over at auction. She even said, it was $100K more than I was expecting to pay for the property. But again, I got wrapped up, was sick of kind of looking around, just wanted a place to settle before the end of the year. So this is strange kind of buying time.
Bit of FOMO in there.
Bit of FOMO, all that kind of stuff. So we saw that happen. And then that is a classic owner-occupier overpaying for a property, and that's why we like these suburbs from an investment perspective, because you're getting into these highly desirable pockets that over the long term are going to outperform. Demographics, we only touched on when we're looking at it, like suburbs to invest in from that kind of rent to owner proportion.
What's the actual number that you'd prefer to see there, Sky?
I like seeing like around 70% owner-occupied, 30% investor. And that's like the norm, like across the market, I would say. Like in terms, if you look at like loan approvals, at the moment, they're a lot higher. Like it's closer to 40% investor loan approvals are going through at the moment. But generally speaking, 70% of owner-occupiers make up the market, 30% is investors. If you're pushing into the 80s, and that's when you're talking about those kind of really desirable locations, whether it's sometimes they're beachside, they've got really good schools, they've just got infrastructure, transport, that type of thing. When we're getting up to like 40% renters, 50% renters, that's when we get a bit nervous. Again, it doesn't mean it's not going to do really well. And particularly in booming markets, you're going to see these market
There's
throughs.
just more volatility.
There's more volatility, I guess, in the down times, whether that's when the market kind of tanks or gets going back 5 or 10% a year and investors get nervous, but they're already up 30, 40%, they're going to sell all those properties. Not necessarily, but they might sell them. The other one's obviously the vacancy rate. When, let's say, a market is kind of underperforming, if it's predominantly made of investors, you've got more people all trying to kind of rent out properties at the same time, which is then going to kind of put downward pressure on rents, and that vacancy rate is going to increase as well. So just something to consider. I guess when everything's going great, then no one cares, but then when things are going bad, that's when that kind of renter to owner proportion really kind of comes into its own.
I think one other thing, and we've touched on this before with other episodes, is when you're looking at what's happening in the data versus what's happening on the ground. So Frankston North is a great example where the renter to owner ratio is not quite in that sweet spot. It's a little more swayed towards renters than we would like. But on the ground, we're seeing first home buyers, owner occupiers wanting to get into that suburb. So you can sort of balance what you're seeing in the data and what you're seeing on the ground.
Yeah, exactly. The other one, ERSAD score. So when we're talking about, I guess, the kind of socio-economic status of a suburb, 1 being the lowest and 10 being the highest, we want to see that above 3, I'd say, in the most part. The guys over at Hashtag did a really interesting review that over the last 10 years, every suburb that went from 500K to over $1 million had to have an ERSAD score over 3. There weren't any across the country. So again, if you're looking to kind of double your money in these kind of middle ring suburbs, it kind of needs to have a decent ERSAD score. So again, for us, I would say we're targeting 3, 4 higher for our particular purchase that we're looking for. To be honest,
for this SMSF purchase.
Exactly, yeah. But
what about for a general investor?
Again, it's a nice to have. From an investment perspective, again, like if you'd only looked at, and this comes down to price point, I should clarify. If you're $750K and below, I'd say it would matter less. But I wouldn't want to be spending $1 million in a ERSAD with a ERSAD score of 1, 2, or 3. And that's because it's obviously a less desirable suburb despite that higher price point. And based on that kind of evidence that the guys at Hashtag worked through previously, it just doesn't make sense. Whereas if you'd ruled out, and a lot of investors do this, they rule out anything with, say, 1 or a 2, you would have made a lot of mistakes over the last few years because it's the bottom end of the market, and obviously, i.e. the more affordable suburbs that have been booming and that have been doubling in Perth, in Townsville, in Melbourne, like for instance, like Frankston North, one of the best performing suburbs in Melbourne over the last 12 months, you would have ruled that one out.
It's an ERSAD score of 2 in Frankston North.
Exactly, yeah.
3 in Carrum Downs.
Yep, yeah. So you would have knocked out those things entirely if that was your kind of defining kind of investment metric. So that's another one. The other one we look at as well is like affordability. So I guess the affordability index, how many years does it take to buy a property in this location? The numbers can vary. You typically want 40 years and below. But I think that number's starting to become less and less reliable just because people are having to pay more for properties and that affordability index, like you can say everything's overvalued, which if you use historical kind of calculations, it would be. But again, like we're not in a bubble. property prices aren't about to just blow up and go backwards. People are finding ways to pay more for property, whether that's rent vesting and they're not actually the ones buying in a particular suburb, or because people have got dual incomes now, all that type of stuff. So that affordability index has definitely kind of creeped up over time.
So could just go back and could you touch on a little bit what the affordability index is? How is it measured? How's it calculated?
Yeah, sure. So it's like an indicator of mortgage stress. And it's basically saying if you have a loan in this suburb based off, I think, so let's call median house price, how many years will it take you to pay off that loan?
Based off median income or average income for that suburb?
Yeah.
Very good.
All right, so bouncing around a little bit, both macro and micro, but the next thing we look at is the house price. So a lot of people use median house price. For the listener to the podcast, we know we prefer typical house price, which again, people like HTAG and others use because it gives you the ability to see, I guess, in more real time what's actually happening. So it's not a 12-month where properties were selling 12 months ago are factored in as much, that it's weighted towards more recent sales. So for us, we've got a budget of 1.2 for this super purchase. We're not going to look at only suburbs with a typical house price of 1.2 and below. We'll look at 1.3, potentially 1.4, because we know, based on experience and I guess our skills at buying property, we will be able to get properties under that typical house price, whether that's we're buying one that needs a little bit of work or we just get a really good off-market deal. So we don't want to rule out those suburbs a little bit over when we can actually kind of sneak into those, I guess, more premium or higher-end suburbs if we can. The next part is the growth cycles. So we're not buying into a suburb that has grown 15, 20% the last 3 years. In Melbourne, that hasn't happened anywhere. Most of
the North was, 14%?
Yeah, well, I was going to say, I think 70 or 80% of the properties we purchased have been the top 3 performing suburbs in Melbourne this year. So we've done that, and they're all about 14%, those ones I'm referring to. However, for us, it's not going to have done that for 2 years in a row here in Melbourne. So for us, we're identifying ones maybe earlier in their growth cycle, and that's why I really like this kind of 1.2 purchase price. So anyone that's got 1.2 to spend, I still think Melbourne is the best market for it, and we'll get to those suburbs in the next episode. But we really like it because it hasn't moved too much yet. The rent yields are dropping back more towards 3% as opposed to 4%, but for us, we'll be targeting something 3.5% and above, and they just haven't moved as much. So like a lot of the other locations, the growth cycle where it's at, it's, I would say, the lower end's kind of into that kind of upward trajectory. It's definitely picking up. Whereas in this kind of 1.2 mark in Melbourne right now, it hasn't moved too much at all. So we're some suburbs, I'd say, would still be falling off a little bit, but the others are just beginning that growth cycle. So for us, I think it's 2026, especially early 2026, is the perfect time to be getting into these markets. But so that's why we're going to rule out some of those higher performing ones for this. But for us, yeah, super excited about what's available in that kind of 1.2 price point.
And I guess that's why we're ruling out, like, not just for this purchase, but just when a lot of clients come to us saying, I want to buy somewhere, I've heard Townsville's really good, I've heard Perth's really good. Those markets have had their run. They are at the top of their growth cycle, and that's what generally we're trying to avoid when buying an investment property.
Yeah, and if you own property there, I wouldn't be too concerned right now. Like, they're still growing.
It will still grow.
It'll still grow. The 5% deposit scheme is just kind of giving everything a second wind. But for us, particularly for this kind of purchase, like from a super perspective, we're looking into it saying, you know what, let's get in the start of the growth cycle and get 10 really good years of capital growth out of this asset.
Okay, what other factors should we be considering?
All right, so then when we're working through the suburbs, we're now kind of in the classic kind of demand and supply, and we're looking at a bunch of different indicators. So again, long-term listeners will know some of these already, like my favourite numbers getting around in the world. But if we start the supply side, so let's start with maybe stock on market. So stock on market is the percentage of properties available for sale in that suburb right now. We always want to set that below 1.5%, like even below for a lot of the markets we're buying right now. But for us, because we don't have this kind of crazy like equity extraction timeline in, say, 1 or 2 years, we're happy for it to be a bit longer. I'm happy to put that up to more like 2% at the moment, even a bit higher if we could find one with the right downward trend in that number. I'd be considering that as well. But for us, let's work off 2%. Building approvals, again, like I guess the new supply coming to the market, we'd want to see that one below 1% still kind of across the board, particularly for this purchase as well. We don't want to be buying in your Clyde Norths, Clyde, all those markets we've talked about previously on another episode where you got building approvals and almost into the double digits, and there's just so much supply coming.
So just to make that really, really simple for listeners, let's say we have a very small suburb with 100 houses in the suburb. You're wanting stock on market less than 2%. So that's saying there's only 2 houses for sale in that suburb of 100 houses.
Yep.
And the building approvals, there's only one or less houses being built in the next foreseeable future at the moment.
Yep.
Okay.
Yeah, which I guess if you're going back 10 years, that would seem crazy. But like we are in a housing crisis. And so there's actually more of those suburbs out there than I think people think. Even Melbourne. So Melbourne, like if you, like, and we do this as part of our strategy sessions for clients, but if you kind of plot out like a heat mapping tool, which is what we do, supply. So stock on market. Most markets in Melbourne, the supply is less than 2%. And it's the same across a lot of other capital cities. So the supply is actually really tight. What's missing, particularly in the kind of $1.2, $1.5 million market and above in Melbourne, is demand. There's no demand. And so when there's no demand, homeowners think, you know what, maybe now isn't a good time to sell. And so what happens then, supply kind of shrinks even further because they're not looking to sell because they know it's not the optimum time to sell a property. So it's this kind of self-fulfilling prophecy where it goes round and round, supply gets tight. And then eventually prices do pick up because there's just so few properties, demand picks up a little bit, and that's when we start to get that price growth. And that's kind of the suburbs we're looking to target with this purchase.
And what about inventory levels?
Yeah, another one. So again, we like to see that under like under 3 months is still quite competitive, but in this kind of day and age, in a housing crisis, anything under 2 months is really good. And basically, inventory levels, let's say the number's 2. What that's saying is that if no new properties are listed online for sale, it would currently take 2 months to sell all existing properties available for sale based on the kind of market absorption rate right now. So basically 2 months worth of stock. Yeah, there's another way to kind of sell it.
Mm-hmm. And so what about the demand side? What are you looking for there?
Yeah, so that's when we go to I guess, data points like days on market. So if you list a property online today, how many days does it take to sell? For us, we want to say that below 30. We will go for this purchase probably a bit higher, maybe even 40, 45, just because we're timing that entry into like an early adopter market. So we're getting in nice and early. Sub 30 is like a kind of a hot, warm market, and that's where we're already seeing capital growth. We're seeing the market start to move quite a lot, whereas we're happy to get into the market a bit earlier. Like our previous purchases, like we're buying in Rockingham back in 2021. So we've got a suburb. I've got a property in the suburb Warnbro over there. It was in the probably 50s that days on market, and that sounded high when we got into it. But we're picking up dirt cheap properties for less than they were selling 10 years ago, and that days on market number was 120, probably 3 or 4 months earlier. So it'd gone from 120 into the 50s. Is now in like 7 or 8 days. I haven't checked it again recently, but it's got down that low. So we're happy to go higher days on market as long as that trend line's looking positive. Like we don't want to go to one where it was 30, now it's 50. We're going for one that was 120 down to 50, if that makes sense.
So those that are really in the weeds with data, that's that short-term slope. So over the most recent period of time, you can see that it's decreasing as opposed to increasing.
Exactly. The other one, obviously, is around like vacancy rates. So from the vacancy side of things, we don't want to be buying a property where we're not going to be able to get tenants, like it's pretty basic. But again, we want to set that below 2%. And so for the most part, we do across Melbourne, it's mostly under 2%. In some suburbs we're buying, it is actually a little bit higher than that. But for us, I think the markets we're buying in, there's very limited stock, both to buy, but also to rent as well.
Could you talk a little bit about investor-led and own-occupier-led demand? Is there a difference?
There is. So like places like Ballarat, Bendigo, Darwin, there, I would say investor-led markets right now. Is there money to be made? Absolutely. You're going to make a lot of money buying in those markets. But again, in the short term, but again, like the fundamentals right now, it's not homeowners, locals buying those properties for the most part. It's interstate investors either chasing yield, chasing hotspots. It's also quite large buyers agency buying 10, 20, 30 of these properties a month in these locations, which again is kind of this false demand that's driving up prices as well, which I guess sucks for local homeowners. But again, they're just not markets we'd be chasing.
And how can people sort of find out whether that growth is investor-led or not?
Well, there's a few ways. The most reliable, though, is actually looking at the finance data. So like basically the approvals for locations. Like Darwin stands out like quite shockingly when you look at those kind of finance numbers of, I guess, who's applying for loans to buy property in these locations. That'd be the rawest. This is the anecdotal side of things, speaking to agents, when they say 90% of properties we're selling is into state BAs. That's the other way to find out. But yeah, a lot of the time it's in the finance numbers. There's obviously a lot of other data points we go through. They're the kind of the key ones we look at when we're trying to filter stuff out. The other stuff you kind of touch on, like the kind of shorter term slope, so the more recent changes in some of these data points we track. But I think for now, we'll park the specific data points.
That's a lot. We haven't even got onto property selection yet.
Exactly. So let's say we've got 5 suburbs. We're probably down to about 5 suburbs right now, and we are actually going to work through this process and work through these suburbs at a later date. But for now, let's say we've narrowed down to 5 suburbs. we kind of know the one or two that we're interested in, let's go buy property. That's kind of the stage we're at right now. So for us, I'd say, I can't actually remember how many, like 16, 17 points. We go through like our due diligence checklist for all our properties we buy for clients, which we'll obviously use for ourselves as well. Let's start with, I guess, the first one, which is overlays. So for us, it kind of comes down to what you're looking to do with the property. For us, long-term set and forget for this purchase, but we might have people come to us and say, I want to build a granny flat, subdivision, 1 into 3 subdivisions, all that type of stuff. So for overlays here in Victoria, it's a few key ones. Obviously, you're looking for stuff like the bushfire overlay, which is an annoying one if you're looking to develop, I guess, particularly or even just build a granny flat, because it does change the quality of the build you have to do. So you have to do a high quality build.
It doesn't exclude you from doing
it doesn't exclude
a granny flat or a second dwelling.
Yep, just the cost.
Changes it. Yeah.
Exactly, and the cost to build. Again, we're not talking crazy numbers, but it is something you have to consider. Flooding is the most obvious one.
So what's the issue with flooding? Like I know, but for our listeners, because a lot of the people that live in those houses will say my house is never flooded even though it's in a flood zone. So why is that something that an investor should be thinking about?
Yeah, I mean, there's a few ways to look at it. One is like you don't want the house to flood.
Of course.
That's the obvious one. But you pointed out like there are a lot of properties that are in flood zones. I guess flood zones.
The 1% chance.
Exactly, yeah, but have never flooded and probably never will. The second one is like insurance, particularly the way they calculate it these days. A lot of it's automated. If you're in a flood zone, you might just default paying a higher insurance rate. So we obviously check that as well. We haven't bought any flood zone properties in Victoria. No. Anywhere, sorry, I should clarify that. But there's one, I was looking at property in Franks North that off market in the 600s the other day, and it ticked a lot of boxes. I went through the property off market and it was in a flood zone. I was like, Frankston North, what are you doing to me? Like of all the places. And yeah, there's probably 3 properties in Frankston North that are in flood zone, and this was one of them. I was like, oh, well, there you go. So that property is still available. And this is probably
closer to Seaford area, I guess.
Exactly, close to that Seaford. And it's because like obviously the way the water flows down that main road and then it kind of trickles into this one street. Again, worst case scenario, that's what happens. So interestingly though, and this is why investors should care, it's a property available in Frankston North in the 600s and it's still available. And again, I think it's because a lot of people look at it. Going back 10, 15 years, owner-occupiers wouldn't have even thought about it, and investors wouldn't have been like, oh, that house is in a flood zone, because it would have been a lot harder to identify. Whereas now there's probably 10, 15 platforms on the internet where you can search something and it's going to say this property is in a flood zone. And if you're an interstate investor, you don't want to buy it because if you have reservations about it, another investor is going to have the same reservations in 5, 10 years whenever you look to sell a property. And what we're seeing right now is potentially some homeowners also were like, no flood zone, not worth the risk. So yeah, I don't know. If it wasn't a flood zone, the property would be worth 50, 60K more. Like that's what it should be selling for. But it's currently still available for sale, which is obviously quite rare for the suburb.
What other overlays in Melbourne?
Yeah, so the other one that we see a lot, like the cultural overlay, we see that one pop
so
up.
The Aboriginal cultural sensitivity overlay?
Is the most common one. And that, again, if you're looking to a 1 into 2 or a granny flat, it doesn't impact it. It does impact it, and you have to get an assessment done if you're building more than 2 dwellings on the site. So just keep that one in mind.
So if you're looking to build 3, 4 townhouses, that sort of thing.
Yep. Mm-hmm. Yeah. Heritage overlay is the other one we see a fair bit as well. So that's kind of overlays. There are obviously a few others, but they're the main ones. Zoning is the next one. So if you're talking about if you want to do these kind of developments, or whether you can't do developments at all, you have to check the zoning and just see what zoning. It obviously varies council to council and state to state, depending if you're not looking in Melbourne. So definitely check out the zoning, because that can have, I guess, positive, like very positive outcomes, or very negative ones, depending on what you're looking to do with the property.
Another one we haven't touched on is flight paths, and where the property is located. It may not be near an airport, but you may still be under a flight path, and that noise pollution is there. Yeah,
particularly the northern suburbs up and around Tullamarine, Dallas, all that kind of pocket. You do see a lot of that. We're also doing some buying in and around Cheltenham, Moorabbin, down that way. So again, that's probably some of the suburbs we'll be targeting for our purchase. Just definitely keep that in mind as well. I'd say a little tip is to go when it's busiest. So for us, when we're buying in and around Moorabbin and that kind of location, it's really busy on Saturdays and weekends, because it's a lot of like hobbyist, pilots and that type of thing, as opposed to the huge commercial ones, which you get at the main kind of Tullamarine airport. The other two, they're different, but I'll cover them together. Easements. So a lot of easements on property, whether that's sewer, whether it's something else, please check those. Conveyancer can do some of those checks. If you're using a buyer's agent, they should definitely be doing those checks. We do see some weird properties, like it's usually from past clients when we run through their portfolio, and you have like multiple easements on the same property and you can't build anything on it, that type of stuff. So check that out. And then covenants is the other one that you do see a lot in Melbourne as well. So you can get covenants removed, but it's expensive. You sometimes have to go through the courts. It's a process. It's just a headache you don't really want to have, particularly if you are looking to do some form of development. The most common ones we're seeing, on the lower end, you get stuff from 60, 100 years ago when the house was first established and built. It's like the fence must be at least 1.1 metres high or something like that. Like that's a covenant you can see, which you don't really care about. Other ones we see are the house has to be made of 80% brick and stuff like that.
So that includes if you're going to do an extension or a renovation, You have to make sure that it also abides with that covenant.
Yep. Yeah, so there's that. But the one that we see the most that ruins some of our deals, and like there's a property that we loved but we actually pulled out of, is because it says you can't be more than one dwelling on that site. So again, like Cranbourne, Carrum Downs, a few of those other suburbs, you will see this covenant pop up. I wouldn't say all the time, but more than I'd like to see, annoyingly. I know there's been people successfully get those covenants removed to build a granny flat or a second dwelling, so it is doable. But again, there's a process and you don't want to spend $800K with the expectation of doing that and then not actually getting that covenant removed. So just something to consider there.
And I think the difference with the covenant is when you're looking at a specific property, and you're doing your due diligence, generally you can check things like zoning, overlays, easements yourself, but with the covenant, it's attached to the title. So you generally don't know whether there's one on the property until you get the Section 32.
Exactly.
And that's included there in those documents.
Yep. Yeah, which is, I guess slightly different in state by state.
Yeah, definitely. What else should we be considering?
Yeah, so the two other big ones are social housing. So we check that as well. Like in some of the suburbs are buying in, like there's some pockets that are 25, 30, 40% social housing, where then if you go a few streets away, it's 0, 2, 3, 4%. So that's the one we definitely check. And I'd recommend checking. There's lots of other platforms out there, including getting it house by house. You can kind of see what that breakdown looks like. And the other one's school zones. So particularly it's not a driving indicator. Like we have a lot of clients that do want to buy in specific school zones.
Like the Frankston High School zone or Bentley West Primary, McKinnon Secondary, those sorts of things.
Yeah. So for owner occupiers, very important. But if you're in a suburb where there is not like a particular well-known school, it probably matters a little bit less. But if you're buying in some of the ones you mentioned or others where there's a very highly desirable school, then making sure you're in that school zone versus 1 or 2 streets out definitely matters. Other stuff now, and this is kind of going a bit more narrow, but like not on main roads, not on roundabouts, all that kind of stuff. Like there's
opposite of school. You want to be in the school zone, but not opposite.
Yeah, exactly. or it's not even not opposite. Like sometimes opposite can actually be better than what you do see, which is maybe a street off where like everyone parks. And sometimes they can't park out front of the school; they park the street around, which is even busier than where the school is. But yeah, we've had a lot of property in Frankston North, which is opposite schools. Like a lot of properties we've seen in the last 6 to 12 months, which we just haven't pulled the trigger on because the location is just obviously not ideal. So we've avoided those. The other one which I've seen, there's a great example of another buyer's agent buying one, and it's like petrol stations.
Why?
Yeah, backing onto a petrol station.
No.
Like there's a property, it was online for ages. It just sat there. Someone, Interstate Beer, come and scripted it up and talked about how they can build a granny flat and stuff like that. Where they didn't mention is that you've got a petrol station in the backyard. And I don't know who is going to live in a granny flat on a house that is 2 meters from a petrol station. But anyway, some people are obviously buying them. There's a bunch of other, obviously options as well to consider. And from a due diligence perspective, I've actually got a couple written down in front of me. I'll just quickly go through some other ones. Building materials. So where there's a brick, is it a fibre house? Is it a concrete build, which we have actually purchased? But again, you've got to factor that into kind of your valuation. The obvious one, the condition of the property as well. So when you're doing your comparables, don't compare the fully renovated 3 and 2 with your 3-bedroom, 1-bathroom original condition. They are not the same property, and you've got to have that kind of factored into that purchase price as well. So that's when a lot of people go wrong, particularly interstate investors or people can be in the same state but not looking at the property. We hear a lot of people buying property off agent video walkthrough videos and then having issues when they're like, oh, but the agent didn't show me this when they did the video, which, I mean, of course not. They don't work for you. They work for the vendor. And just like the maintenance costs that you might not factor in if you bought a newer or better looking kind of property. So like particularly in Victoria, the minimum standards, like we're going to get new blinds put in. We've got a client at the moment who we've got to pull out like a old school wall mounted heater again because it's not to code anymore. It's obviously it doesn't meet minimum standards. So just stuff like that, you could be in for 5 or 10K for like it could be a very good property, but you're still going to be up for that upfront. So factoring those costs in both your CMA, but also to your own, I guess, cash flow when you're looking to buy a property. Pools. So interesting I've got pools jotted down here because I actually don't mind buying properties with pools.
In certain locations.
Yeah, just not in Melbourne. Not some suburbs in Melbourne I still would. This is from an investment perspective, of course. Perth, I have no issue with buying a house with a pool. It's got the highest pool ownership in the country. So again, when you want to appeal to own occupiers, it makes sense to have a pool, even if you're an investor. Our property in Perth, it's got a pool. Charge a premium rent. We pay for the pool maintenance. I wouldn't have it any other way. It's probably our best performing property in terms of day to day. So again, I'm not opposed to it, but I can see why a lot of people don't. And particularly if you're in the kind of 400 or 500K window buying somewhere else, having a pool, 2, 3, 4K outlay to fix something on a pool on that kind of price point can be quite significant. At a $1.5, $2 million purchase price, a few $1,000s here or there for maintenance is obviously a different kind of, different type of scale. So again,
so it comes back to your strategy and goals with this particular purchase as well. Like if you're a high income earner and you really want to be negatively geared, maybe having something with, that higher purchase price, it's got a pool, you don't mind that the cash flow is not quite as good. Yeah,
and in some cases you get a better rent as well because you get a pool as well. So there's lots of variables. So I'm definitely not do not buy a property with a pool. It's a bit more circumstances and I guess almost investor kind of risk tolerance as to whether you'd have something like that. Right, there's a lot of data points and things we look at. We obviously look at there's a few others we look at as well, but in the interest of time and obviously listeners' interest, we're not going to run through all of them, but if you are interested in that full list, let us know because we can probably push that out in the show notes or something like that. As well, particularly it's the time of the year that people are probably a bit more time and they're probably potentially looking at some properties themselves.
One thing I did want to touch on before we close off though is development potential. So a lot of our clients come to us and they want to buy a property with development potential, like a bigger block, it's always got subject to council approval, all those sorts of things, but they never have any plans of developing it themselves. So why is that attractive to many property investors?
Yeah, I think it's just the thought of doing it. It's an interesting one because I feel like every second property in Melbourne has subdivision potential subject to council approval. Like it's almost like agents just put it in there. If the block's over like 400 square meters, they're going to put it in there. And like I've pointed out to them, I was like, you can't subdivide this block. Or
there's a covenant
saying you literally can't do what you're saying. Like, oh, it's up to the council. I was like, well, it's not in this case. So like stuff like that. So like I think people like development potential. Like we have a lot of people reach out to us and say, want to do a granny flat? Yep, happy to do that. I might want to cut it up and sell one off or build a second dwelling. Can happy to do that as well. Other people just like the potential to do it.
Someone else will see that potential and may be willing to pay a premium.
Exactly.
Because they want to develop it, not necessarily the
And so that's the other one that we do buy is like we'll buy one with potential and that's us telling the client this property has this potential, you should buy it. Even if you don't want to, I can guarantee that in someone, like let's say it's corner block, house is perfectly positioned to one side, you subdivide, build a second dwelling without demolishing the first. That kind of stuff does have weight and value. So even if you don't want to do it, in the future, someone's going to come knocking on your door asking to do that. So just something to keep in mind as well. And that's where all that conversation around easements, zoning, that's where that matters.
Trees. There are big trees. You have to factor that in.
I should have mentioned trees as a standalone item. If you're interested in development, whether it's granny flat, subdivision, multiple townhouses, trees are a huge thing. I don't know if it's just Victoria, but like obviously you have to make sure.
Council by council.
Exactly, yeah. Which trees are on there. Like it actually matters which tree, not just any tree. Some trees you can just pay and get removed.
It's native.
Exactly, yeah. Whereas you can get caught out if you've got the wrong type of tree on your property. Like we had one in Frankston North that we, again, thankfully worked through that due diligence because we wanted to build a granny flat. And before we put an offer in, like we basically had the offer ready to go. But it was an annoying tree. It was a type of tree that you can't remove, and so we wouldn't be able to build. So we didn't even put an offer in on the property in the end, which was annoying. But it is what it is.
And the other one you haven't mentioned with development potential is looking for site access. Are there any requirements around that, or is it just better to speak to the local council and the town planner there?
Yeah, I'd say speak to the town planners. Like the general rule, like in some there's like you need 3 meters. But again, it does vary. So I'd definitely check out that if there is that's for full subdivision as opposed to kind of granny flat.
Now, I think it's worth saying this is a lot of information. There's a lot of data points that we've gone over. It's not our full list. There's definitely many other things people could consider. But it's worth noting as well, there is it can come at the cost of that opportunity. So getting analysis paralysis, we see that a lot where clients come to us and they just want to tick every single box and they spend so much time going over the information that they never actually take action. And so they actually miss out on all that growth.
Yeah, that's actually a really good point. Like that analysis paralysis, we see people come to us that they struggle from that and they've been looking for over 12 months to buy a property. And it's because they're trying to meet every single one of these kind of points and more that they think are important. And I'm like, I've never heard of that one before, but yeah, sure. No, I did worry about that. Like the other one we see more of is like the house number. Like obviously if you look at like Chinese culture.
Cultures are superstitious.
Exactly, like the shape of the block, all that kind of stuff. And the one they hate the most that we also get the most is like, I spoke to my family and they said X, and leaning on, let's just call them out the boomer generation of like, oh, I wouldn't buy that property because of X or Y. And it's really getting in people's minds and stopping them from actually taking action and getting stuff done. So even if you don't use us or you don't even use a buyer's agent, you're doing this yourself, no perfect property exists. And like we've obviously ran through that checkpoint, that kind of some of the key things we look at. We'll still buy property if it doesn't meet one or two of those things, as long as the value's there.
It's going to meet your goals you set right at the beginning.
Exactly.
You outline your strategy.
Yep. Yeah. So don't try and meet every single one. This is definitely a guide. And like as I said, we'll buy properties that don't meet all of those. Again, if it's the right price and it meets the strategy that we're going to set out to do. Right, that was a lot of talking.
So what's next to come though, Sky? You mentioned this is sort of the start of like a series of episodes and there's the SMSF purchase for...
Yeah, so what we're going to do, obviously over the kind of, let's call them summer months, obviously hopefully we get good summer weather these 3 months. We're going to do a few different episodes. So this one was obviously just an overview of kind of the thought process. The next one we'll actually kind of probably go break down and talk through the suburb selection. And we'll go through that as like that 1.2 price point. Where are we looking? Why we're looking there? And we'll actually step through what that looks like. And then finally, we'll probably do this is our little story of what we purchased. I don't know. We'll wait and see what happens there. But what I also want to do is map out some of our purchases for the year. So not talk about the clients themselves, but like we've purchased multiple properties for multiple clients this year. So like 2-3 properties for the same client. And I want to kind of talk through how we've done that. And that's because we've had a clear plan and a strategy. And it's all about equity extraction, buying in those kind of really hot markets, getting a below market value. We're talking 70, 80, 100K below market value sometimes, and then pulling that equity out and going again. So I kind of want to map that out. I've got a few different platforms we can use. So we'll have a few episodes that may be different. There may be no video. It might be more kind of sharing a screen. We'll wait and see. But some pretty exciting episodes to come over summer. So if you don't already, and we always forget to do this, please subscribe to the podcast because we never tell people to do it. But yeah, subscribe. There's some really good ones coming out over the next few weeks.
We do also have a bit of an announcement for 2026. We will actually be moving to weekly episodes. So at the moment, we're on fortnightly. You're going to be seeing more of us or hearing more of us if you're listening on Spotify. So stay tuned because, there's a bigger and better Melbourne Property Podcast coming in 2026.
And we should have a new hire by then as well. We are going through a recruitment process at the moment. So we should hear, we'll make sure we get them on at some point, but we will have a new hire early in the new year as well. So we'll make sure to get them on and talk all things property.
Very good.
Thanks for the time again today. Hopefully that was of interest to the listeners. If there's anything else, other questions, comments, future recommendations for episodes, as always, reach out. But look forward to speaking to you more in 2026.
That's a wrap for this episode of the Melbourne Property Podcast. Just a reminder that this information is general in nature and should not be considered financial advice. If you'd like to discuss your personal situation, book a discovery call with the team at Conversions Buyers Agents. Our link is in the show notes.
If you learned something from this podcast, hit subscribe and never miss your fortnightly dose of Melbourne property insights. Catch you next time and happy house hunting.